The people who run the numbers of what gold has to go to in order to actually be able to back the world's fiat currencies say it's got to go a lot farther. 10,000 is the minimum number that you see when people are talking like this and running those numbers. So $10,000 an ounce gold is coming. The question is, will $20,000 or $30,000 an ounce come? That's a scary world. So it's exciting for stackers, but terrifying for basically everybody else if we end up with a world where the fiat currencies are so devalued that gold is now $30,000 an ounce. But it's a completely feasible, completely possible world, which is why we should all be acquiring precious metals.
The US dollar may soon face a $2.5 trillion wave of selling as Asian nations begin unwinding their holdings of the world's reserve currency. Financial analyst John Rubino warns that if global currencies continue to weaken and a new monetary system emerges, potentially involving gold, the metal's price could rise sharply. Rubino's forecast suggests that $10,000 per ounce may be needed to back fiat currencies, with more extreme estimates reaching $20,000 or even $30,000. Amid this uncertainty, gold has remained in focus. After 2 strong days of gains and a bullish breakout, gold briefly rose to $3,439 before encountering resistance. It is now trading in the lower half of the day's range, with $3,360 serving as short-term support. A drop below this level could lead to a test of lower price supports. Driving this momentum is the ongoing effort by countries like China and Russia to diversify away from the dollar. Both have been steadily increasing their gold reserves to hedge against sanctions, currency devaluation, and to lay the groundwork for a gold-backed trade system potentially. In China, investor interest in gold has surged, with trading volumes on the Shanghai Futures Exchange reaching record highs. In response, the People's Bank of China has issued new import quotas for bullion, further fueling demand. Meanwhile, Beijing has taken steps to support its slowing economy, including reducing policy rates and lowering bank reserve requirements, setting the stage for upcoming trade discussions with the U.S. According to Goldman Sachs, central banks have increased their gold purchases nearly 5-fold since 2022, following the freeze of Russia's reserves. The cumulative effect of these moves suggests a growing global pivot toward gold amid mounting distrust in fiat currencies and geopolitical instability. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Well, gold is where we hide out in times of chaos, and so that's one explanation for gold going up. People just don't want to be exposed to any more risk than they absolutely have to be. And that leads people to buy things like gold and silver. Plus, you've got the BRICS thing going on where, and this predates a lot of the political turmoil in the US and Europe, but a lot of countries have just gotten sick of the US using the dollar as a reserve currency weapon against them. So they're taking steps to protect themselves should they have to go back to some kind of gold standard or just start bypassing the dollar in trade. And so their central banks, especially China's and Russia's, have been buying gold aggressively for years now, and they haven't been very price sensitive. So that in part explains why the price of gold has gone up more or less steadily, while other things have bounced around in such a crazy way. And then you've got the Basel III thing going on, where global banking regulations have changed, and gold's status has been upgraded from a tier 3 asset, which you had to hold reserves against gold if you wanted to own it if you were a bank. They've upgraded it to a tier 1 asset, which is the reserves that you hold against other assets. And because of that, a lot of the banks in the world are accumulating gold alongside their treasury bonds and their US dollar cash, and they don't seem to be too price sensitive either. So that's kind of why gold, add all that up, and that's why gold pierced $3,000 an ounce so smoothly. Normally, you would expect that to be massive resistance, right? Because traders, well, humans in general, but traders in particular, like big round numbers. And when an asset gets near a big round number, you expect a lot of trades to be input there. And when something is going up to hit that number, then the trades are sales, and they knock the asset back down. It took gold like 4 years and multiple attempts to get beyond $2,000 an ounce. And this time around, it just blew right through 3,000 with no trouble. So anyhow, that's in part why. There are just a lot of reasons for people to be buying gold and ignoring the price as they do so. Now, whether that continues or not, there's no way to know, but that explains the recent past. we know that we're inflating away and generally mismanaging all the big fiat currencies, right? So that they're losing value is to be expected just based on the amount that we're creating. And that's been the case. We've had inflation in the West and parts of Asia for a long time. And that's cash going down in value. And that's also bonds going down in value because all bonds are is proxy for cash. They just pay you cash, and that's where they derive their value. So, no surprise that everything else left off the table, just our financial mismanagement of the past 30 years, should be leading cash and sovereign bonds to lose value, both in nominal terms and relative to gold. So yeah, we are creating basically banana republic world right now. And almost nobody is immune to this. Basically, Russia is the only country that's not really debt ridden, and I guess Switzerland, although they're more like a banking sector that calls itself a country. So, but Russia's a major country, and they don't have a lot of debt. But everybody else, we're all wildly over indebted. We all have to create huge amounts of new currency in order to manage our debts. And other things being equal, that's going to lead the currencies and the bonds that are based on them to go down in value over time. Now, gold is probably the end point of this process. We're going to have to, at some point, declare a new Bretton Woods agreement that might be a flat out gold standard or might be something that's some kind of hybrid standard. Who knows what they'll come up with and whether it'll work, but gold will be involved in the next financial system. So if you're a central bank or an individual investor, you really want to own some of it, right? Because it's the bedrock money of whatever comes next. And so that gold is $3,000 an ounce is, it's surprising that it happened this fast, but it's not surprising that it's there. And the people who run the numbers of what gold has to go to in order to actually be able to back the world's fiat currencies say it's got to go a lot farther. 10,000 is the minimum number that you see when people are talking like this and running those numbers. So $10,000 an ounce gold is coming. The question is, will $20,000 or $30,000 an ounce come? That's a scary world. So it's exciting for stackers, but terrifying for basically everybody else if we end up with a world where the fiat currencies are so devalued that gold is now $30,000 an ounce. But it's a completely feasible, completely possible world, which is why we should all be acquiring precious metals.
John Rubino warns that the U.S. is heading toward a severe financial crisis. While certain Trump-era policies, such as reshoring manufacturing and exposing institutional corruption, offered some structural benefits, they have not addressed the core issue: unsustainable debt. With federal, corporate, and household liabilities all at extreme levels, there is no painless way out of the situation. Adding to the pressure, Treasury Secretary Scott Bessent stated that an updated estimate for when the U.S. will run out of cash, the so-called X date, will be released soon. He acknowledged that the debt ceiling is already on the warning track. The Treasury is still processing a large wave of federal tax receipts from the April 15th deadline to refine its projections. Since the debt ceiling was reinstated at $36.1 trillion on January 2nd, the Treasury has been using extraordinary measures to keep paying the government's obligations without breaching the statutory borrowing limit. However, these temporary solutions are running out, and the looming fiscal constraints could intensify market volatility and accelerate de-dollarization efforts globally. Let's get back to the interview.
Well, if we're speaking just of the U.S., right, Trump's doing a lot of really good things, but at the cost of a lot of chaos, kind of overlaying on the good things. But, accomplishing the good things like, the U.S. government and the public-private sector here were basically just a big money laundering scheme to help the political class. And the fact that we're finding that out and we're taking steps to stop it, that's incredibly good. And the fact that we're aggressively trying to get factories to come back to the U.S., that's all good too, But there's only so much you can do to control spending when you reach the point where we are now, where the government's debts are above 100% of GDP. Interest is spiking. And it's not just the government, it's every other sector in the country. The corporations are over indebted, individuals are wildly over indebted. So there's no real way to fix that. In other words, to implement some policies that painlessly take us back to organic, steady, non-inflationary growth, you can't get there from here. So we basically have to have some kind of a crisis that's related to all of our debts and the interest costs of that debt. And then we have to do, the Jim Rickards currency reset thing in some way. So, there's no way that Trump and his people succeed if success is defined as a return to normalcy in the short run. That just can't happen. But we can lay the groundwork for a healthier society when we do the currency reset, because there's no guarantee that a currency reset is even doable at the place we're in now. But if we can be resilient enough to up the odds of, devaluing the dollar dramatically and linking it to gold without bankrupting half the country, then we have succeeded in a realistic way, in a way that we actually can succeed. So I think there's a chance of that still happening. It's interesting seeing what a lot of people are trying, or at least the goals that they're pursuing, because they're good goals. And if we achieve some of them, then we have a chance of coming out of this without a revolution and absolute chaos. It's not really helpful to look at the currencies versus each other because they're all declining, just at varying rates. So, I mean, if you're a trader and you want to short the euro and go long dollars or vice versa, then yeah, it makes sense to look at who has what momentum and everything. But they're all doomed. All the big currencies are going to decline at an accelerating rate until they cease to exist in their current form. But their rate of decline at any given time is going to differ. And a lot of the stuff that we're doing in the US right now is potentially bad for the dollar versus other currencies because maybe it's sending capital out of the US and into other currencies. Maybe people are upset with what Trump is doing with tariffs or whatever, and that's causing other countries to pull capital out of the US and move it to other places, and that makes the dollar go down versus the euro and the yen and the yuan and maybe the ruble. But that's kind of a sideshow to the big story, which is that we've all just ruined our financial systems, every major country. We've all taken on too much debt, and the consequences of that will be declining currencies going forward. So, whether the dollar goes down versus the euro right now, let's say in the next year, doesn't really change most people's investment thesis, right? If you want to get beyond fiat currencies in general, then you're not really caring in the short run whether the dollar or the euro is the quote unquote strong currency in any given year. You want to be moving into real stuff. So you want oil and you want uranium and you want gold and silver and farmland and stuff like that. And, no matter what happens to the US dollar index in the year ahead, I think that's still in place. We still should be moving towards real assets, maybe at an accelerating rate lately.
The accelerating global shift away from the US dollar is reshaping the financial landscape, with rising demand for gold reflecting mounting concerns over debt sustainability, geopolitical fragmentation, and weakening fiat credibility, as nations increasingly bolster their bullion reserves and explore alternatives to dollar-based trade. Gold is emerging not just as a safe haven but as a foundation for potential new monetary frameworks. At the same time, fiscal constraints at home, combined with elevated public and private sector liabilities, are tightening the noose on U.S. financial stability. Together, these forces point to a tipping point in the global monetary order, one where gold could reclaim a central role in value preservation and international trade. Is the world on the brink of a monetary reset where tangible assets like gold could displace traditional currencies as the foundation of trust? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.